For folks who are skeptical for why is this happening, I think those concerns are valid. Like, yes, absolutely, this is part of a business growth ambition for asset managers who are, of course, making and behind some of the advocacy here. But at the same time, I think the flip side of that is that the potential benefits and the potential outperformance of private markets, like, it's a real thing, right? Like, historically, private markets have outperformed public markets in many different contexts.
Hi, this is Matt Pauker with Wendy Lee. We're co-founders of IV Invest, and welcome to this week's episode of The Investment Office. Every week here, we talk about the latest in capital markets, alternatives, and retail investing. Today, we're going to be talking about long-term investing, in particular retirement, as well as investing for your children. And maybe we'll kick it off by talking about something that's been in the news a lot this week and the last few weeks, which is Trump's latest executive order covering alternatives, private markets investing in 401k plans and other defined contribution plans. Historically, we've typically seen that most 401k plans only include investing in stocks and bonds, and this is proposing to open that up and create more opportunities for a wider variety of asset classes in retirement plans. What's interesting, though, of course, is this is actually nothing new for what are known as defined benefit plans or pension plans, where historically we've certainly seen private markets be a component there.
Yes, that's exactly right. So large pension plans, whether that be corporate pension plans or public pension plans, they have been long-time investors in alternative investments, whether that's private equity, whether that's real estate, hedge funds, and various other alternative investment asset classes. For individual investors in 401k plans, that has not been an option. And the reason it's been an option for pension plans is these are large pools of capital, they're aggregating assets, and so they can serve as large institutional investors. They have typically in-house dedicated investment teams that have the sophistication, the expertise to go and invest in various different asset classes with different managers and pursue different strategies. Individuals who have been fortunate enough to have and to be able to participate in pension plans may not even be aware that they have exposure in their pension plans to these types of investment asset classes. But over the longer term, the ambition and the investment into privates is typically to generate, obviously, to potentially generate higher returns, to continue to deliver higher benefits to all of the plan participants. For individuals, most of us who don't have access to pension plans or who are not participants in defined benefit plans, that has not been an available option to invest in privates in our retirement plans. And so I think this is in some ways a way to sort of equalize that access in terms of the retirement assets that someone might have and which type of plans they might be participants in.
And where do you think the push for this is coming from? I mean, certainly, I think we would obviously both certainly agree that retirement investors broadly should have access to these kinds of investments. But is this push coming from the private equity managers, the private credit managers? Where do you think this is coming from?
Oh, I think there's definitely a push coming from the asset managers themselves, right? I think folks are leery. And when I say folks, I mean that could be plan participants, individual investors. It could be the plan sponsors. It could be policymakers. I think where you are hearing objections, oftentimes it is folks who are looking sort of glancing sideways at the asset managers who themselves are, of course, interested in making this push to be included in retirement plans and the 401k plans. And so don't get me wrong, like, it would be fair to say this is not an altruistic endeavor in that sense, because from an asset manager standpoint, there is a large pool of capital that is held in 401k defined contribution plans. There is a large pool of capital that, from an asset manager's perspective, has a lot of attractive attributes that the asset managers themselves would like to tap into. Their size, their sort of the duration of those assets. And then, of course, if you are in the institutional investment world, you're familiar with the fact that a lot of existing large institutional investors, like endowments, foundations, where I spent the bulk of my career, there has been a pullback somewhat of continued investments into private markets. And so as large asset managers look to grow their asset base, because that is, of course, an ambition, it is a natural next large pool of capital that is a potential pool of capital for asset managers to tap into. And so, like, unequivocally, I think there are those reasons that, for folks who are skeptical for why is this happening, I think those concerns are valid. Yes, absolutely, this is part of a business growth ambition for asset managers who are, of course, making and behind some of the advocacy here. But at the same time, I think the flip side of that is that the potential benefits and the potential outperformance of private markets, like, it's a real thing, right? Like, historically, private markets have outperformed public markets in many different contexts, and of course, everything there's nuance to it. There's certainly questions around, are the types of investments that could potentially go into 401k plans the same types of investments that institutional investors have been investing into for so long? And so those are all fair questions, but I don't think it's like a clear, this is being done for purposes that are only self-serving to the asset management industry. I think there is a real potential benefit for individual investors to be able to participate in private markets. And so, again, going in eyes wide open, recognizing that this is not, for the asset managers who are advocating for this, it's not necessarily a fully altruistic endeavor, but that doesn't mean it can't be a win-win for everybody.
One of the things that you mentioned earlier was the ability for the pension plans, given their scale and relative sophistication, to be able to evaluate these and make informed decisions around the kinds of investments they're going into. One of the things that I think is really interesting here, if you look at the history of this executive order, this is actually the third in a series of orders coming either directly from the president or from the Department of Labor related to this topic. The first actually was in the first Trump administration, where the Department of Labor issued guidance that made it permissible for the first time for private equity to live in certain kinds of 401k plans, particularly things like target date funds. And then a subsequent letter from the Biden administration that said, well, hold on, wait a second here. Maybe some of these plan administrators and fiduciaries are not necessarily fully equipped to go evaluate the kinds of investments that are being proposed here. And it didn't stop it, but certainly said there should be some care here, particularly for smaller plans. And now what we're seeing with this latest executive order, which is interesting in that it doesn't really actually do much. The two things that it does do is it, one, rescinds the former Biden letter that kind of issued caution, and then expands the set of alternatives beyond private equity to include things like private credit and digital assets and real estate. And then the third thing actually is it instructs the Department of Labor to come up with new rules. So as to whether we'll be seeing private markets in 401k plans at scale anytime soon, I think is TBD. And certainly from a lot of the folks that I've spoken to in the industry, I think there's going to continue to be a hesitation on the part of plan administrators, of employers, to adopt private markets because they perceive fiduciary risk and the risk of lawsuits should a particular investment go sideways.
Yes, I mean, that's going to be, I think, the big piece where folks are going to need additional clarity is, as a plan sponsor, as a fiduciary, what are the implications, and does this make it such that employees could potentially file lawsuits with them? And so I think that is something that has to be absolutely ironed out before there's widespread adoption. But I will say, so in certain contexts, the availability of private equity in 401k plans actually does exist. It's a very specific and narrow slice of 401k plans that can and have, to some degree, offered private equity investments or alternative investments in their 401k plans. There's this narrow slice of investment options called CITs, collective investment trusts, And these are investments that can be much more flexible in terms of what they're investing into. And they are not SEC registered products. They can only take in capital. There's very specific rules about who can be an investor in these CITs. And one of them is one of the potential and allowable participants are defined contribution plans of a certain size. They typically do have to meet size minimums. These are typically offered through a financial advisor. So if a plan sponsor works with a financial advisor, they may have access to one of these CITs. So this is just to say, like, it's not that private equity entirely does not exist at all in 401k. There is some precedence. It just is a very narrow sliver under very specific circumstances. And I think what the new executive order is designed to do is to expand the availability of private equity, and I would imagine first in target date plans.
I suspect this will not be the last time we talk about this. Turning now actually to perhaps the other end of the age spectrum, the other piece of legislation recently passed are these Trump accounts targeted at children. In some sense, yet another new investment option, tax-deferred investment option for young people. What's interesting about this one is for the next few years, children born will be receiving $1,000. TBD how that's actually going to be received, but they'll be receiving $1,000 each from the federal government. And then beyond that, this new legislation enables families and potentially employers to contribute up to $5,000 in total each year to children under the age of 18 in a similar way as a 529 plan. These Trump accounts don't have as many permissible spending options that are tax deferred, which makes them potentially less interesting. But what I thought was interesting was in the language of the law specifically, they call out what the permissible investment options for these Trump accounts are, and they specifically call out the S&P or another index, broad-based U.S. equity index with an expense ratio of 10 basis points or less. And so I thought that was an interesting choice that they made to be so specific in the language for these accounts.
Yeah, I think it makes sense to some degree if you were to say that what is an investment option that will be better understood than most, that is going to raise fewer objections than most, and where performance has been excellent, and where it is a part of the market where fee compression has driven fees on these index funds down to really almost de minimis costs. Like, it is there. I understand why these are the options that are being offered.
Yeah, that totally makes sense. And so, while these Trump accounts relative to, say, a 529 plan do have more restrictions on how you can spend the money, at the end of the day, free money is free money. And for folks that are going to get that, they should take it and let it compound and leverage that. But for parents of kids who were born before the Trump accounts, or these Trump accounts, the free money will end in a few years. Then, of course, the question becomes, well, what's the right structure to invest through, whether it's a 529 or custodial IRA, and what are what are the ways in which you can use that money, but I think in some ways, more importantly, what are the investment options you have depending on the structure that you're leveraging.
Yeah, exactly. I mean, if you are a parent whose child is going to be a beneficiary or recipient of one of these Trump accounts, then that's fantastic. And there's no complaints, right? You're not going to complain about what your investment options are when you've got free money. And the investment options are perfectly attractive and perfectly reasonable. If On the other hand, as a parent, if you're thinking about, okay, I want to set money aside for my child, I want to be able to invest that money to grow, then all of a sudden, to your point, like, there's a much wider range of options that are worth considering, whether that's a 529 plan. And 529 plans, of course, run state by state, and each does have its own set of permissible investments that will vary state by state. And again, those are still limited options, but a menu of options that's certainly going to be wider than pick one of the index funds that are available with the Trump accounts. And then really, I think where you have the greatest flexibility as a parent, and from an investment standpoint, if you're putting in net new dollars and investing on behalf of your child, I think the custodial IRAs, custodial Roth IRAs, are going to provide the greatest flexibility, right? Because there you have the ability to select from a menu of options. Whatever exists for an IRA or Roth IRA are things that are available to that custodial account. And then, of course, the big offsetting piece to it is it's a retirement account. It's an IRA, whether it's a Roth or traditional, but that custodial IRA is you're giving your child an early and head start on investing for their long-term futures.
And so I guess going back to the earlier part of the conversation, that would be a structure then where someone could consider private markets as part of that long-term IRA investment.
Yeah, and I think that's really a question then of, where could or where do privates fit into the conversation? Should privates be part of the conversation for retirement assets? If you were to ask me, and having been on the institutional investor side, where again you think of the natural advantages of being a long-term investor, that time horizon is a distinct advantage, and so with that time horizon, the ability to take advantage of that investment time period, the ability to take on investments that are less liquid, providing, of course, that as an investor you're compensated for taking on some illiquidity there. It's known as the illiquidity premium. Then I think the closest comparable to that long-term investment, institutional investment dollar from an individual standpoint, especially if you're young, but even if you're, in sort of that midpoint of your life, those retirement dollars have to stay invested for decades, oftentimes, depending on sort of how old you are. And so you've got this really long time horizon. And so there is, I think, a greater ability to take on that illiquidity within your investment options, and a greater ability to hopefully capture the illiquidity premium and to be able to take advantage of what private markets have to offer. I think this again goes to when I think of what are the advantages to certain types of pockets of capital. I think retirement capital for individuals, there is in a lot of ways a duration match for less liquid investments like those in the private markets. And then the final piece of that, of course, is that investment capital and retirement plans, retirement capital is tax advantaged, right? And so there's the ability to compound without a tax drag, and so if you are able to participate in private markets and generate potentially higher returns that compound tax-free for a number of years, it again just speaks to where I think it's the closest comparable to a lot of the endowment foundation institutional investment capital type of capital that I spent a lot of time investing.
And maybe just to dig on that point, because I think it's a really interesting one. When you are investing from a pool of capital that is tax advantaged, like a retirement account or like an endowment or foundation, how does that change how you might think about the kinds of investments or the ways in which you would invest?
Yes, absolutely. There are certain types of strategies where an investor is absolutely going to benefit if they can invest with tax-advantaged dollars. So I think of certain strategies that are more trading-oriented or trading-heavy. They're going to generate a lot of interim, short-term gains. Those types of trading-oriented strategies that oftentimes can be found in hedge funds. Again, this is why I think endowments and foundations have been long-time investors in hedge funds, because the ability to generate and receive those returns without tax implications is a pretty big advantage. I think after-tax returns on some of those strategies can really look quite different. And so there are certain strategies where there's just, it makes so much more sense to be able to invest in if you can do so with tax-advantaged dollars. High-income-oriented strategies similarly are again, because income is taxed at a much higher rate than long-term capital gains, then, for instance, it is a net benefit to be able to invest in those strategies with the tax-advantaged dollars. On the flip side of it, actually, you can think of things that generate really high outsized returns, and where being able to collect on those returns without a tax consequence is enormously beneficial, right? So the ability to invest in something that can generate outsized returns, say in like venture, and then to not have to pay taxes on those gains if you are investing with, let's call it Roth, like if you had as an individual, just hypothetically, Roth IRA dollars that could invest into venture type investments, and the outsized gains that you could generate that would not be subject to any sort of taxable consequence. You can think of sort of on many ends of the spectrum. There are ones that are explicitly have big differentials in returns between tax advantage and taxable dollars, and then there are others where it's just you generate the potential for such high returns that to be able to do so without tax consequences is just, again, it's meaningful because of the size of the potential tax consequence, because the size of the returns, right? So it really could cover both ends of that spectrum.
But generally sounds like an opportunity for folks to take advantage of that a lot of folks, I think, today are perhaps not fully taking advantage of by being only invested in stocks and bonds. And I think we're seeing certainly the rise of more self-directed IRA platforms that allow folks to take advantage of that. And then, you're seeing on the extreme end, right, the Peter Thiel example of putting his startup holdings in a Roth IRA and paying no taxes, which is a little crazy, but good for him, I guess.
Well, that's what I was alluding to. But yes, I was debating whether we should call that out specifically. But it is a really remarkable example of the potential for how tax advantage dollars can really be utilized with some powerful consequences.
Awesome. Well, more topics on this front to come, I'm sure, but thank you all for joining us this week on the Investment Office. We'll see you next week.